Having a health savings account, or HSA for short, can help reduce your federal income taxes. The catch here, though, is since you must have a high deductible health plan in order to contribute to a health savings account, usually the young and healthy are the ones who will sign up for a high deductible health plan and will take advantage of an HSA. With a high deductible health plan, you will pay a lot out of pocket to use your health insurance, and younger people usually don't use their health insurance very often. But if you're willing to take on the cost of being in a high deductible health insurance plan, then an HSA might be a good tax savings tool for you. In a bit, we will take a look at the high deductible health plan requirements, the HSA contribution limits, and the limitations and tax benefits of having a health savings account. First, if you want to contribute to an HSA, 1, you can't have Medicare. Once you enroll in Medicare, you can no longer contribute to an HSA. 2, you can't participate in a flexible spending account or a health reimbursement account that reimburses you for qualified medical expenses. You can participate in a limited expense healthcare flexible spending account to use for qualified dental and vision expenses. 3, you can't be claimed as a dependent on someone else's return. And 4, you can't be covered under another health plan. If your spouse has a non-high deductible family coverage plan, but you are not covered by the plan, you can make an HSA contribution. Also, if you're married, you cannot have a joint HSA. You can only make cash contributions to an HSA. You can't contribute any stock or other assets. If you want, you can make a lump sum payment to an HSA. In some states, as long as you make your contribution by the federal tax return deadline, you can take the contribution. The federal tax return deadline does not include extensions, so normally you would have to make your contribution by April 15th. The most that anyone can contribute for 2024 is $4,150 for self-only coverage and $8,300 for family coverage. For 2025, the most that anyone can contribute is $4,300 for self-only coverage and $8,550 for family coverage. If you're 55 or older by the end of the tax year, you can contribute an additional $1,000. If you have more than one HSA, your total contributions to all of your accounts cannot be more than your maximum limit. The limits are the most that can be contributed altogether by you and your employer, and you must reduce your HSA contributions by any ARCH or MSA contributions that you make. Again, you must be enrolled in a high deductible health plan, and these plans have a higher annual deductible than the average health plan. For the plan to qualify, the 2024 in-network minimum deductible for an individual plan is $1,600 or $3,200 for a family plan. The out-of-pocket limits for 2024 can't be higher than $8,050 for an individual plan or $16,100 for a family plan. In order for the high deductible plan to qualify in 2025, the plan must have an in-network minimum deductible of $1,650 for individual coverage or $3,300 for family coverage. The out-of-pocket limits for 2025 can't be higher than $8,300 for an individual plan or $16,600 for a family plan. To contribute the maximum amount allowed to an HSA, you must be enrolled in a high deductible health plan by the first day of the last month of your tax year. More than likely, you have a calendar tax year, so you would have to have coverage by December 1st if you want to contribute the maximum amount. But don't get too excited just yet. If your coverage does not begin on January 1st and you choose to contribute the maximum amount, unless you become disabled or pass away, you must stay enrolled in the plan until December 31st of the following year. If you don't stay enrolled, you will have to pay taxes and a 10% penalty on the excess contributions that you made. If you don't like the idea of having to stay enrolled until December 31st of the following year, you can always choose to contribute a prorated amount. So to determine your prorated amount, you will begin by looking at your coverage start date. If your coverage starts on the first day of any month, you can make contributions starting that month. If you did not have coverage on the first day of a month, you can start contributing in the following month after your coverage begins. For instance, if your coverage starts on October 1st, you can start making contributions in October. If your coverage starts on, say, October 2nd or the 17th or maybe the 23rd or whatever, you can start contributing to an HSA in November. After you determine your contribution start month, you will take the contribution limit and multiply it by the number of months that you were covered. Then you will divide that number by 12 to determine the maximum contribution that you can make for the year. For example, if in 2024 you had single coverage starting on October 1st and you are under age 55, your contribution limit is $4,150. So you could contribute a prorated amount of $1,037.50 for the year. If you qualify to make a contribution during the year, but at some point during the year you no longer qualify, you can still make a prorated contribution for the months when you did qualify. Here's a chart of the maximum that you can contribute for 2024 for the number of months that you are covered by a high deductible health plan. For instance, you can see that if you have 3 months of self-only coverage and you are under the age of 55, you can contribute up to $1,038. Now that we've covered the contribution limits, Here are 5 tax benefits of an HSA or health savings account. 1. You don't have to itemize your deductions to get a tax benefit for medical expenses, but you can't take an itemized deduction for any tax-free distributions that you make from your HSA. 2. You can take a tax deduction for contributions, but you can't deduct employer contribution. This means that you can take a deduction for contributions made by family members such as a parent or a spouse. Actually, it can even be contributions made by a friend. It doesn't matter. The person receiving the contribution can take the deduction, not the person giving the contribution. If you're self-employed or even unemployed, you can make contributions as well. You can make your SHA contributions through before tax payroll deductions, or you can make lump sum deposits. You will claim lump sum deposits when you file your tax return. Again, all of the contributions combined, including your employer's contribution, cannot exceed the limit. 3. The contributions made by your employer will not be included in your income. 4. If you invest the funds that are in your HSA, all the interest and earnings in your account will be tax-free. The nice thing is, you never have to worry about being forced to cash out your investments or close out your HSA. You can keep it if you change employers. You can even keep it if you stop working altogether. 5. As long as your withdrawals are made for qualified medical expenses, the withdrawals will be tax-free. If you receive distributions for any other reason, the distribution will be taxed, plus you may have to pay an additional 20% tax on top of that. Also, you can't claim the health coverage tax credit for health premiums that were paid with a tax-free distribution from your HSA. You can receive tax-free distributions from your HSA to pay for qualified medical expenses that happen after you set up your HSA. This even applies if you use the December 1st rule to make a maximum contribution. So no matter what, you cannot use any medical expenses that you already had before you created your health savings account. The IRS loves documentation, so please make sure that you keep good records to prove that all distributions were made for expenses that happened after you set up your HSA, that all distributions were for qualified medical expenses, that these medical expenses were not already paid or reimbursed, and that you did not take these expenses as an itemized deduction. As a former IRS auditor, I can tell you that not having documentation is how auditors get a lot of audit adjustments. If you're younger than age 65 and you receive distributions for any reason other than to pay for qualified medical expenses, the amount you withdraw will be taxed and you may have to pay an additional 20% tax. If you're 65 or older, you will only pay taxes on non-qualified withdrawals. Your non-qualified withdrawals will be taxed like your other retirement income. Basically, once you reach age 65, your HSA becomes another source of retirement income that you can use for anything. You don't have to make any type of withdrawals from your HSA every year. You can just let it build up in your account until you need to use it. You can roll over your HSA into another HSA and it won't be included in your taxable income, but you can't take a deduction for it either. Also, a rollover will not reduce your contribution limit for the year. You have to do the rollover within 60 days of receiving your HSA funds, and you can do a rollover once every 1 year period. If you have an HSA account transferred directly to another HSA account, it's not a rollover, it's a transfer. You can have an unlimited number of transfers. You can transfer funds from your traditional or Roth IRA to your HSA, but you can do it only once in your lifetime. The funds have to be sent directly from your IRA to your HSA. You cannot have the funds sent to you first and then you send it to your HSA. A transfer from your IRA will not be included in your taxable income, but it's not deductible either. A transfer from your IRA will reduce the amount that you can contribute to your HSA that year. When you make a transfer from your IRA to your HSA, the December 1st rule does not apply, but you will have to keep that plan coverage for a year from the end of the month when you make the transfer to your IRA. If you don't, you will have to include the distribution in your taxable income, and you will have to pay an additional 10% tax on top of that. The only exceptions are for disability or death. For instance, if you make the contribution from your IRA to your HSA on October 17th, you will have to stay in your current plan until October 31st of the following year. Since your health savings account is an asset, please be sure to designate a beneficiary for your account. If you leave your HSA to your spouse, when you pass away, your spouse will treat it just like their HSA. If you leave it to anyone else, when you pass away, the account will not be an HSA any longer, and your beneficiary will have to pay taxes on the fair market value of the account in the year of your death. Your beneficiary can reduce the taxable amount of the HSA by any medical expenses that are paid by that beneficiary within 1 year after your death. If you leave the HSA to your estate, the fair market value will be included on your final tax return. By the way, since you're interested in ways to save on federal taxes, you might want to watch the video in the upper left of your screen about 3 investments that won't increase your taxes. Take care.